I think we're going to have a recession, by the way. And the reason I think we're going to have a recession is that we've had a money supply since March of 2022 that's declined, contracted by 4.5%. And we also see, by the way, the good thing, that might be a bad thing, but the good thing is that we anticipate inflation to be around 2% or maybe below 2% by the end of this year, the consumer price index. So inflation down, the economy probably dipping into recession later this year because of what? The contraction in the money supply. Remember, changes in the money supply are the key to the whole thing. That's the fuel for the economy, the money supply. You got to look at the money supply.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When I interviewed today's guest expert back in August of 2021, when inflation was 5%, he made the bold prediction that the CPI would eventually hit 9%, a prediction that at that time seemed unthinkable, but it indeed proved true less than just a year later. He then called for inflation to moderate substantially, which it also then did. So, where does he see inflation headed from here? To find out, as well as hear his latest outlook on the economy, recession risk, social stability, and the markets, we welcome back Steve Hanke, professor of applied economics at the Johns Hopkins University in Baltimore, Maryland. Steve, thanks so much for joining us today.
Great to be with you, Adam.
Always a pleasure, Steve. I know it's a very busy week for you. Thank you for making time for this conversation. Lots to get through, especially because you're located there in Baltimore and you just had a pretty serious tragedy happen in your city this week. If we can, though, let's start with the general question I like to ask at the beginning of these discussions. What's your current assessment of the global economy and financial markets?
Things are generally sailing along pretty smoothly. However, I think there are a number of risks that are significant. We have two wars going on right now. Obviously, the one's been going on for some time with Russia and Ukraine, and that one doesn't seem to be, even though the Russians are clearly have the upper hand in the thing, it doesn't seem to be winding down. And also the one in the Middle East with Israel and Gaza is not as contained as people like. The narrative coming out of Washington is that it's all contained, or Jerusalem, it's all contained. Everything's very, very carefully calibrated and so forth. But in fact, things are, shall we say, unsettled in the region itself. So we have those two things, and then we have a real confrontation with the U.S. and China. I mean, it's a commercial war that was really articulated and laid out in a long report by the Department of Commerce last April. So there's a lot of uncertainty in the picture, although nothing is crashing and burning as we speak, but.
Okay. And so that's more sort of the geopolitical global economy side. Just curious about the markets. We just finished a barn burner of a Q1. Valuations, you could say, maybe somewhat stretched. What do you think?
Well, let's come back to the U.S. The markets has been a barn burner. I think the market's just a little ahead of where it should be, even though the PEs, what do we got? PE on the S&P around 30. And remember, from 1998 to 2000, it went up to and peaked out at 55. So you could argue the bullish case is it's got a ways to run. But of course, remember, after it peaked in 2000, we then had something called a crash.
Mm-hmm.
So I think the market's pretty cautious, pretty pricey, and I'd be very cautious. I'd be more the Warren Buffett kind of mode. Set a pile of cash and wait until the thing crashes and move in then for for the picking.
Okay. All right. Well, look, we'll get more to the market in a bit, but staying on kind of the global trends, because I know you spend a lot of time, looking at the big macro trends that are driving the action. I'm curious to hear, which trends have your attention the most right now. I do know one of them is, what's happening on the monetary side with countries, and specifically, you track the currency purchasing power, or maybe more specifically, the destruction of the currency purchasing power in a lot of countries around the world. You talk about, a lot of the examples of really almost out of control inflation in a lot of countries. And just to note a few I've taken from some of your writings, Turkey right now is at 74% inflation per year. Argentina inflation doubled during Milei's first month in office. Syria is running at 95% per year. Iran's at 44% per year. It seems sort of like currency's gone wild in an increasing number of countries around the world.
Well, you've got about a dozen that are really in bad shape. You mentioned a few there. The top one actually is Zimbabwe, where the annual inflation rate I measure every day, it's over. It's about 1,200% per year. That's the highest inflation rate in the world. You mentioned Turkey is around 74. That one's interesting because let's go through the ones that you talked about for a minute. Turkey, Erdogan is obviously was reelected and replaced the governor of the central bank and supposedly adopted orthodoxy. They had a very unorthodox policy at the central bank, which was based on Erdogan's ideas. And Erdogan, his basic idea was that you have a positive relationship between interest rates and inflation. So if you want low inflation, you should impose low interest rates. If you want high inflation, you impose high interest rates. So he had the whole thing upside down. He replaced the central bank governor, but they have never been able to get the money supply under control. It's growing at about 65% per year in Turkey. So that's way higher than it should be if they wanted to hit any kind of a reasonable level of inflation. So Turkey's got a real problem. They've increased their interest rates enormously since a new governor has arrived. Actually, they've had two governors. We had one, and she resigned in somewhat of a scandal, and we now have a new one. This is just since Erdogan was reelected last year. The key lesson there and message is that monetary policy is not about interest rates. It's about changes in the money supply. That's the lesson. And that's a lesson we learned from Milton Friedman. So that's the key thing. They have increased interest rates dramatically in Turkey, but they have not been able to control growth in the money supply. And it's the money supply that causes inflation to change. So that's Turkey. Now, Argentina, we had Milei was elected and went into office in December. Since he went in, he has not delivered on his main campaign promise, which was to replace the peso with the US dollar, dollarize the economy.
To dollarize the currency, yeah.
Right. That would have crushed inflation, Adam, but inflation has actually gone up. The official inflation number now is up around 270% per year.
All right, and I'm curious. Do you know why? I read some of your reports saying that you had optimistic expectations for Milei and a lot of his reforms, but the fact that he dropped the dollarization one is really concerning you.
Well, yes, that really is his Achilles heel. I think a fatal mistake, because the first thing you have to do, if you have a country where you have raging inflation, triple-digit inflation, and endemic inflation like Argentina, you have to crush the inflation. That gives you credibility. and it stabilizes the economy. And stability might not be everything, Adam, but everything is nothing without stability. So if you crush inflation, you stabilize the situation, then you can take the next step with reforms. He got the sequence of things all wrong. He abandoned the idea of getting rid of the central bank, getting rid of the peso, and replacing the peso with the dollar. He put that on the sideline, on the back burner, and he started throwing in these proposals for rather radical reforms, which of course have to eventually be done, but he has virtually no credibility. The inflation got worse, not better.
So why do you think he did that? Because you're
Well,
right, it was a huge thing he
I
ran
think
on.
I think he had very bad technical advice, and the technical advice that he'd received from his own people, as well as people like experts from the IMF, who by the way are against dollarization, but they said it wasn't feasible. They advised him you can't do it because the net foreign reserve position at the central bank is negative. And I analyzed the thing very carefully because I know how to do it because I'm speaking as someone who's actually dollarized two countries. One was Montenegro in 1999, and the other was Ecuador in 2000, 2001. And what you need, Adam, is gross reserves that are positive and greater than the value of the notes and coins outstanding, because you have to simply swap the foreign reserves that you have in your hand with the notes and coins in the domestic currency that you're eliminating, the peso in this case. And they had gross reserves that exceeded at any reasonable exchange rate. They could have easily exchanged the gross reserves that they had for the peso notes and coins that they had. So, and I know this as a matter of theory, but I also know it as practice, because in Ecuador, we dollarized when we had negative net foreign reserves, but we had gross reserves that were greater than the Sucre notes and coins that were outstanding at the exchange rate that was chosen to do the dollarization with. So it was all feasible. He could have done it. He just had bad advice.
Okay. Is it too late, or is it something that he could
Well,
get back to do?
you could do it at any time. And I think to pull these chestnuts out of the fire, he should do it tomorrow. I mean, if he dollarized tomorrow, within 30 days, the inflation rate would be down in single digits.
Okay. Well, here's why this matters so much, Steve. I'm just going to pull up here real quick an index that you create. I'm not sure if you want a misery index named after yourself, but you got one. So I know on your misery index here, Venezuela has had the top spot for a long time, but Argentina just pushed it off the #1 spot here. So if you're not getting these policies right, they've got real impact for the well-being of your citizenry.
Absolutely. So I just finished this new misery index, and Argentina is the most miserable country in the world. So you say, well, how do you get the misery index? How do you calculate that? It's simply the inflation rate plus the unemployment rate multiplied by 2, plus the lending rate minus the GDP per capita, the change in GDP per capita. So you've got 3 bad things: high inflation, high unemployment, and high lending rates. And you've got one good thing in the picture that you subtract out of there, which is the change in GDP per capita. As it turns out, that actually doesn't help Argentina, because even that's negative. They're in a recession. So that isn't a positive number that you're subtracting. You have a negative number. So it's not helping you. So everything they have in the misery index is bad.
All right. So Argentina is really in a world of pain right now. Are you optimistic that even if he doesn't dollarize, that Milei's reforms will eventually start pulling that misery down, or do you fear it's going to get even worse?
I think if he fails to dollarize, I think he's toast. Basically, he's not going to be able to get much of anything accomplished. There's a big gap between his rhetoric, and the reality on the ground, because actually he has a very small faction within the Congress in Argentina, and the Congress has already pushed back the reforms that most of the reforms that he's thrown into the hopper. Now, they would not be able to do that if he had dollarized and crushed inflation, because he would have a lot of credibility, he would have a lot of popular support, because he crushed the main problem in Argentina, which is inflation. And by the way, in that misery index, there are two things that are related to inflation. One directly is the inflation number, but the other is the borrowing cost. Borrowing cost, or interest rates on credit, are very related to the rate of increase in the price level, or inflation. And those two things account for about 95% of the misery index number for Argentina. So inflation and very high borrowing costs are basically the whole picture.
Okay. So I want to scroll down here. So we've got a misery index of almost 322 for Argentina. I'm going to go all the way down here to the United States, which its misery index is only at 16.7%, right? So you think, okay, we're much better off than the folks are in Argentina, and I think largely we are. But the two things you just mentioned, inflation and high cost of debt, there's a lot of people watching this video who's saying, like, yeah, my life's gotten a lot worse because of those two things over the past couple of years. So even though we're dramatically better relatively in misery index score to a place like Argentina, like, we still feel the effects of those two things pretty strongly.
Well, that is true. However, the misery index, where the U.S. rank, you ran down that. Let me just look at my scoring here. I looked at 157 countries, and the U.S. is 132. That 16.7 number that you gave, that puts us in there. 132. We're close. Israel is 133. So we're the 132nd out of 157. By the way, the least miserable country is Thailand. That's 157, and then Japan, and then Switzerland, then Qatar, then Malta, then China. China is 152. China is doing much better than we are. Their misery index is 9.8. Now, one reason that's so low is that inflation is essentially non-existent in China right now.
Mm-hmm.
So coming back to the U.S., by the way, just a remark, because there's a lot in the press about this, and that is things are, the misery index score is not all that bad, and things are getting a little bit better. The inflation is coming down. Economic growth has been strong. The stock market's strong and everything. But people have a very negative view of Bidenomics and the performance of President Biden. And I think the reason for that it's twofold. One, they look in the rearview mirror and see what things were like maybe 3 years ago. And they say, well, inflation wasn't nearly as bad, and the economy was doing good. Unemployment was low. Everything was a little better.
And things cost 25% less.
Right. Things cost a lot less. That's one. The rear view mirror is one thing. The front windshield looking ahead is another factor. And they're looking ahead and saying, I'm worried, about some of the risks that we talked about at the opening of the show. what's going on in the geopolitical scene with two wars going on that the U.S. is financing, by the way. The U.S. is financing that war in Ukraine. It's also financing the one in Gaza. And people say, and what about a recession? Are we really going to keep riding along and sailing along smoothly? Maybe we're going to have a recession. I think we're going to have a recession, by the way. And the reason I think we're going to have a recession is that we've had a money supply since March of 2022 that's declined, contracted by 4.5%. Now, this kind of contraction, we have to go back to 1929, 1933, Adam, to find a contraction like this. And we only have 4 contractions since the Federal Reserve was established in 1913 in the United States. And every one of those has always been followed by a recession. So John Greenwood and I, using the quantity theory of money that allowed us to nail the inflation forecast when things went up to 9.1% in 2021, we use that same thing and we see a recession in the cards. And we also see, by the way, the good thing, that might be a bad thing, but the good thing is that we anticipate inflation to be around 2% or maybe below 2% by the end of this year, the consumer price index. So inflation down, the economy probably dipping into recession later this year. Because of what? The contraction in the money supply. Remember, changes in the money supply are the key to the whole thing. That's the fuel for the economy, the money supply. You got to look at the money supply.
All right. So you took this exactly where I wanted to take it. I wanted to get to the quantity theory of money. You walked us through the math of that in previous times I've interviewed you, developed by Milton Friedman, or at least championed by Milton Friedman. And like you said, you use that to nail the 9% target many, many months before we actually hit it. Like I said, back when you made that 9% prediction when I was interviewing you then was unthinkable to many people, but yet it played out like you said, the math said it would. So that same math tells you that it's going to be below 2% by the end of the year. And because of the importance of contracting money supply, that drives that equation, but that also drives the economy. And generally, as a declining monetary supply leads to declining economic growth, ergo your prediction for a recession.
Yes, and then we go back to the market. We were talking about the market. I said I thought it was a little bit pricey. I prefer a Warren Buffett kind of move, kind of cautious, backing off, piling up cash in anticipation of a slowdown in the economy. Because once it slows down, earnings slow down, free cash flow slows down, and multiples contract. And the market backs off. So that's kind of my general sentiment on the market is it might very well continue to go up. Remember, I said it went up quite a bit higher than it is right now in terms of PE ratios in 1998 to 2000. But of course, we know what happened after that. After the peak of the PE, it came tumbling down. That was really something that was more related, I would say, to kind of a bubble type situation.
It was a mania. It was a psychological mania where folks were chasing all the .com promise. Yeah.
Right. That was the so-called .com bubble.
So
and now, by the way, you've got a little bit of this now. By the way, we had the .com bubble. Now we have kind of an AI bubble, kind of. AI is going to transform the world. All of a sudden, the potential. Some people say the potential growth rate in the United States for GDP now it's about 2.2%, and they say, oh, with AI it'll jump up to 6% or something. I think they're drinking Kool-Aid from Silicon Valley, to tell you the truth. This is just not going to happen. But there is that, as they say now, they don't call it a story, they call it a narrative. That narrative is swirling around that we're going to have huge improvements in productivity in the United States and elsewhere because of AI.
And you know what? I mean, maybe we do. I mean, a lot of the promise of the dot-com story or narrative back then did come to fruition over time, but it took a long time. And what happened is so much of the future value was pulled into the present during the mania that price was just pulled way too far into the future. And so, the correction had to happen, but over time, a lot of that promise did get fulfilled. Maybe the same thing will happen with AI, who knows? But it just seems like a similar pulling in of tomorrow's value to today is happening right now, and that may have to get bled out.
Yeah, I agree, and a little bit overexcitement and unrealistic. I mean, you just don't see those kinds of huge jumps and changes in a country's potential GDP growth rate. It just doesn't occur.
All right, interesting. So because I think you expect GDP to slow from here, given the contraction in the money supply. None of this is personal financial advice, but I would expect that you would probably favor bonds right now, at least maybe U.S. Treasuries, because they're paying a lot more than what I think you expect inflation to be at the end of the year. Would you, A, is that true? And B, might now be a good time to go further out the duration curve to lock in today's interest rates if you expect inflation to be that low in a year?
Well, yeah, the answer is yes, your characterization is correct, because interest rates follow inflation. In other words, inflation, wherever inflation goes, that leads to changes in the interest rate. So if we go out on the duration, I mean, the key interest rate is a 10-year treasury. So if you go out to the 10-year, I think that's a pretty safe bet for a trade, not necessarily an investment, not something where you take the 10-year and put it in the safety deposit box and forget about it. But as a trade, I think it will be probably a profitable trade, because the interest rate will fall as the inflation rate continues to fall and goes down to, I think, let's say 2% by the end of the year. If the inflation rate is at 2% at the end of the year, believe me, the 10-year yield is going to be quite a bit lower than it is now. I mean, it's up above 4%, a tad over 4%. It'll drop down, and you'll have a pretty good capital gain. So that's how you want to trade. You want to trade it, not invest in it. Is what I'm saying.
Got it. Yep. And even if it takes longer than you think for inflation to hit that target, you're still getting paid a positive real return for figuring out how the story ends. Yeah.
Absolutely. So I think that's a pretty, the odds are very much in your favor on the being along the 10-year right now.
Okay. Well, since we're talking about inflation and interest rates, what do you expect monetary policy to be for the rest of the year? Do you think Powell's going to deliver 3 interest rate cuts? There's a lot of reasons why it optically might be difficult to do that in the short term, just with financial conditions as loose as they are, markets at all-time highs, unemployment rate still at quite low readings, and even though there's probably a lot you and I can talk about it, the true health of the employment market might be, or do you think he's eventually going to get the air cover to cut because inflation's going to moderate the way that you think?
Well, if if history is a guide, what the Fed right now is focused very much on the labor market and what's going on in the labor market now. That happens to be a lagging indicator. Things happen in the labor market after economic activity starts changing. So if you go into a recession, what happens? You don't lay off your people and get rid of them right away. You hold on to them because you've usually invested a lot in their human capital development and so forth. And you don't like to get rid of labor.
Right. And sorry to interject, but they always say generals fight the last war. On the labor side, we laid off 40 million people during COVID, and then companies had to go back and hire those people back really quickly and realized how painful it was to lay somebody off and then have to scramble to bring them back on. So they're remembering the pain of that, which is why they're hoarding talent so much.
Oh, absolutely. There's no question about it. So what if let's just walk through this scenario. The Fed is and historically has in these situations looked very carefully at the labor market, and the labor market won't start really deteriorating seriously until the economy is already tanking. So if we go into recession, what's going to happen with the labor market? The labor market will tank a lot with a big lag relative to what's really going on in the economy and profits and everything else. So they'll be late to the game. So I think they will pivot eventually, because if we do go into a recession, which I think we will go into, the labor market will eventually start deteriorating, and at that time the Fed will take action, but it'll all be too late. So as a result of this, you get this roller coaster ride up and down with the Fed, and that's the basic problem with the Fed. They're not looking at the right thing. They're ignoring changes in the growth rate and the money supply. To hit the inflation target in the United States of 2%, and to keep things on an even keel, the rate of growth in the money supply measured by M2 should be about 6% per year, Adam. And now it's about negative year over year, negative 2%.
2%. So I think I told you this before we hopped on. Your outlook for declining inflation because of the contracting money supply and then concerns about recession. You're right there with Lacey Hunt, so it's good company to be in there. I also hear you saying it's not different this time. Probably, the script is probably going to follow the way that it has in recent history, where I think for the past recessions in living memory, like the past 4 or 5, they've all been preceded by a rate hike campaign by the Fed. Then we plateau for a while, and then we hit recession, and then the Fed is cutting desperately, but it's because it's behind the curve and it's trying to catch up to what's going on. Sounds like you see something very similar is likely ahead in the future.
Well, yes. I do, and remember again, you're talking about interest rates here, but monetary policy is not about interest rates. It's about changes in the money supply.
Yeah.
Keep focusing on the money supply. So that's another reason why I have a very cautious stance right now, and I'm not an enthusiast about the market. The market's going up, and I'm kind of not on that bandwagon.
Got it. I'm definitely detecting caution from you. So I asked you about monetary policy. Let's go to fiscal policy. So the Fed is actually, I want to say they've been showing restraint because they've hiked interest rates so aggressively and they're doing QT. Now they've been doing other things that provide liquidity to the markets, like the drawdown of the reverse repo program and some of the stuff they did with the BTFP. But in parallel, you've had the fiscal side of the equation just going full drunken sailor, right? Where we've got massive deficits as a percent of GDP. It's levels we only see during like world wars. So what do you expect from the fiscal side going forward, especially in an election year?
I don't think things are going to change very much.
All right, and what will
Uh,
that do to the
it,
economy? Will it
it, it,
short-term
it,
stimulate the economy still, or?
no, this people are always confused about this. If you look at fiscal policy and monetary policy, monetary dominates, and it always dominates. So
Okay, and sorry to
it's all
interrupt, but in your answer, can you address fiscal dominance? Because there are a lot of people that are saying that we're in a period of fiscal dominance, which people are thinking, okay, that means that fiscal policy is more important.
well, there's nothing in the historical record to indicate that that's true, either in the United States or anyplace else. It it it, it and one thing that's tricky about looking at it, to really find unambiguous cases that people can understand, you've got to find situations where the fiscal and monetary policies are going in opposite directions, and then you can figure out if which one's dominating.
Who wins that tug of war? Yeah, got it.
Who wins that tug of war? That's the only way to do it without getting out in the weeds with econometric studies and so forth that most people don't understand. So when we look at the United States, when did we have a super tight fiscal policy and a, I wouldn't say it was excessive monetary policy, but moderate monetary policy, reasonable monetary policy? They were essentially going in opposite directions. It was in the Clinton administration. It was in the 1990s. Clinton, most people don't realize, since World War II, Clinton was the most fiscally conservative president in the United States, by far. Reagan was, Eisenhower was, but Clinton was really on steroids. Remember, the last 2 years of the Clinton administration, we were actually running surpluses.
Yeah, we had that blip of a surplus. Yeah.
So you had very tight fiscal policy, and the fiscalist would say, "Oh, that's going to drag the economy down. That's going to slow things down." On the other hand, Greenspan was the chairman of the Fed, and the monetary policy was rolling along. It was a pretty steady rate of growth, reasonable, but it was positive and reasonable. And what dominated? Money. And if you go to other cases around the world where you get these extremes where the fiscal is going one way and the monetary is going another way, the monetary always wins.
All right. So monetary always wins. So I don't want to, well, does that mean that what's going on fiscally is kind of irrelevant for the rest of this year?
Well,
Or?
it's not irrelevant, because if it's out there and you have a big fiscal deficit, it's potentially dangerous, because what might happen is what happened in 2020, 2021, when the Fed was the one buying all the treasuries and monetizing the deficit. And when they did that, of course, that increased the rate of growth in the money supply. That's why the money supply shot up. In its peak, it was growing about 27% year over year, the money supply. And that's because of why? That was because the Fed was buying about 90% of all the treasuries that were being issued. Yep. With that ballooning deficit that was occurring. Right now, they're not doing that. As you indicated, they're engaged in quantitative tightening, so they're not buying the treasuries. They're running off treasuries off their balance sheet. And that's one reason, by the way, that the money supply growth is contracting. It's anemic, and it's actually below that 6% Hanke's golden growth rate that would be consistent with hitting a 2% inflation target. It's a negative 2%. It's not a positive 6. But
Right.
that's because in part of quantitative tightening.
So what are the odds of us, if that doesn't change, if we stay at that -2%, what are the odds of us actually maybe flipping into deflation at some point in 2025 or 2026?
We could in 2025 if they stay on this. If the contraction year over year continues at -2% for much longer, we could very well see a outright deflation in 2025.
Right. And I'm guessing that's why Powell has recently been jawboning about, hey, at the Fed, we're talking about reducing QT. He hasn't said ending it yet, but reducing it, because I got to imagine with the reverse repo program being set to hit 0, that's kind of been an offset to a lot of QT. Without that, then you really feel the bite of the QT, correct?
Right. So you're talking and thinking logically, but the Fed is not logical, Adam. They're not looking at the money supply. Like you and I are talking about the money supply, and we're talking about the credit counterparts that explain why the money supply goes up and goes down. That basically is that's our conversation.
Mm-hmm.
But the Fed has been adamant that they don't think there's a reliable linkage between changes in the money supply and changes in economic activity or changes in inflation. That is the position of the Fed. So whatever they're looking at, they're data dependent. So they basically have their finger in the wind. They're looking at all the data that come out day after day after day and trying to decide what in the world to do. And most of the data that come out, they're all lagging indicators.
They're looking at lagging indicators.
They're all looking at lagging indicators. Now the reason that that's dangerous, if you think in terms of the quantity theory of money, and I said the fuel for the economy is the money supply.
Changes in the money supply. Yeah.
So we get changes in the money supply happening, and then with long and variable lags, other things happen. Asset prices change. We get changes in economic activity. We get changes in inflation. But those come way after the changes in the money supply that have happened. So if you're data dependent, you're looking at data today that has been caused to move around because of something that happened a year and a half ago, or maybe 2 years ago, or maybe even 3 years ago.
All right. So this is obviously why the Fed is chronically behind the curve. You expect them to continue to be behind the curve going forward. So you're talking about something that I mention on this channel all the time. So I'd love just to clarify your point of view on it. I talk about the lag effect, and it's a lonely conversation in today's world because the narrative has moved on to, it doesn't matter. It's different this time, right? We had the most aggressive hiking regime along with quantitative tightening, and it hasn't mattered, right? And so it's not going to matter. So forget about hard landings. Forget about soft landings. We're going to have a no landing scenario going forward. Sounds to me like you feel like, no, the lag effect is real. Maybe it's been delayed by certain things, rising liquidity, whatever, but it's going to manifest. Is that an accurate summary?
Yes, it is. And the only thing I would add to the long lag is that we have found that these lags are highly variable too. So it's a very tricky thing to get into precise forecast of what's going to happen, because the lags between changes in the money supply and changes in economic activity, they're not only long, but they're variable. In other words, it's not some off the shelf kind of formula that, oh, the money supply surges and we know that in 18 months the economy will surge. It's not like that. Maybe it'll surge in 6 months. Maybe it'll take 2 years. Maybe it'll take even 3 years. So you have to be watching everything all the time. It's fine to be watching the data, but you've got to have this lag thing, and your picture. Otherwise, you're just going to be looking at noise basically. If you don't look at the source of what's changing these data day to day, which always goes back to the fuel. The fuel for the economy is money.
All right. And when did the money supply start tipping negative?
I will tell you exactly. The year-over-year number started tipping in December of 2022.
Okay.
It,
So,
it, it, it was slowing down big time before that, but the year-over-year number went negative in December 2022. And if we look at the 3-month annualized rate, that went negative in June of 2022.
okay. So it
So
sounds like from what you're saying is the big lag effect to try to figure out here is the lag effect from when money supply started to shrink, right? And it's been shrinking now for a year and a half on a year-over-year basis, roughly.
yes,
Yeah.
yeah,
So in other words, it's not a blip we have to worry about in the data series. It's an ongoing trend, right? So at some point that lag effect will catch up with us, and presumably the longer that the money supply continues to contract, the longer or the bigger whatever that lag effect from it's going to be whenever it arrives is going to
right,
last for longer.
and now let me. You set this thing up beautifully the way you've explained it. It's very clear. The one thing in the picture, remember that in 2020, early 2021, we had a huge explosion in the money supply, and that put, shall we say, a lot of excess cash balances in the system,
Mm-hmm.
and that is only now been drained out of the system. The excess cash balances, that would be M2 divided by GDP. M2
Right.
divided by, that's the cash balances. So that's been drained out. That's come down to about the trend rate right now. And what that means is it pushes the lag out, you see.
Right.
If that big balloon of excess cash and money hadn't been in the system, we probably would be in the tank right now.
Right now. So Steve, I've used this analogy so much on this channel that folks are sick of it, which is that all that stimulus you're talking about, that's the pig in the python, right? We shoved this massive pig into the python. It's taken a long time to get through it, right? What you're saying now is making me think of another analogy, which is after the python swallowed the pig, somebody put a grenade in its mouth. So we have to wait for the pig to get through the python, which is almost done. But at some point, that grenade is coming through the python and is eventually going to go off, and that's going to be the period of whatever negative stimulus is, right? This shortfall, right?
Yeah. Oh, yeah. You could put it, instead of the grenade analogy, you could say with the negative. So the pig is gone out. Okay, and now you also have leakage in the system.
Right, or maybe not a grenade. Maybe they gave
body fluids in the python are leaking away.
or leaking away. Or I was going to say maybe instead of a grenade, they put a big pill of Ozempic in the python.
Yeah.
And so it's now going to get a lot skinnier.
Yeah. Right. That's exactly what's happening. It's gonna get a lot skinnier, and we can anticipate seeing this on the scene. I think the second half of this year, it's gonna start showing up. It's not, you can't really, you can see it now if you slice and dice everything. There's kind of a little weakness showing up here and there, but you'll start seeing it to be more pronounced a little bit later this year.
Okay. So last point on this, and then we'll start wrapping it up. So given the size of this Ozempic pill, right, which is it's not a tiny pill, it's a decent sized one, because you said the money supply has been contracting now for over a year or for a year and a half, and it's still ongoing, right? So does that mean if we start seeing the impact of the lag effects from this, say by the end of the year, second half of the year, whatever, do you expect a prolonged period of us having to deal with this? So like maybe, just
Well,
your outlook for 2025 kind of look like prolonged recession?
well, it obviously depends on what the Fed does from now through the end of the year, because again, with the lag in 2025, what happens in 2024 is relevant. What happens to the money supply? I mean,
Yep.
so it depends on what's going on in the money supply, and we don't know. I mean, are they going to stop QT? Is something going to happen that actually causes them to ease up? No,
Right.
I don't know. It doesn't look like that.
It doesn't look like it, at least until June, that they're going to do anything.
Right. That's what, if you look at the federal funds futures market, the Chicago Mercantile Exchange, they have the first reduction in Fed funds and loosening, let's say loosening up coming in June.
Right. And that's a 50-50.
A modest amount, not a radical change, but just the market is pricing in a modest loosening up starting early in the summer.
Right. And of course, the market's been wrong for over a year, in terms of what the Fed's going to do, right? It was always pricing in a pivot. Earlier this year, it was pricing in 7 rate cuts this year.
Oh, yeah.
So,
but they listened to Powell, and he caught, if you listen to him, and you're data dependent like the markets, you change your perspective on where you think the Fed's going to be going.
all right. So let me put it this way: unless the Fed takes somewhat drastic action this year, it seems like you think 2025 is going to be a rough year economically.
Yes.
Okay. All right. So in just wrapping it up here, Steve, we talked about, a lot of the challenges, a lot of things not being done right from a policy standpoint, a lot of the problems we have. I actually didn't even get to this point, but I'm going to just mention it. The U.S. Congressional Budget Office's latest long-term predictions indicate that by 2044, interest costs will be greater than all discretionary government spending combined. Right? We've got a massive debt problem in this country that seems to only be getting worse. That's a whole probably other discussion for us. But the concluding question I want to ask you on this general topic is, if I made you King Hanke, Emperor Hanke, what reforms would you prioritize right now?
Oh, the thing it does get into this budget, because what you just said is that the Congressional Budget Office is saying that there's a fundamental structural problem with the public finances in the United States. And either you change the structure and you cap government spending in some way, or we're going to have to increase taxes tremendously to pay for this. It's one of the two. And I'm for a debt break, a Swiss style debt break. And the Swiss put in a debt break. They made a constitutional change after having a referendum. And the debt break is basically says that the government spending in Switzerland can't go up any faster than the rate of real GDP growth. So
GDP growth.
So the government can't crowd out the private sector, and they must, in the intermediate period, 1, 2, 3 years, actually 2, 3, something like that, balance the budget. That's the Swiss debt break. Now, the only way you can do that in the United States is to have a constitutional amendment, and that means you have to invoke Article 5 of the Constitution, which I'm for, and having a constitutional convention to look specifically and narrowly at the fiscal situation and the idea of putting some kind of debt break in that would restructure the government's finances. It would make the structural change that you would have to control things. And if you don't do that, we're going to be in for very heavy taxes.
All right. So I think what would happen there is it would constrain economic growth. The economy might not grow as much because it's not being debt fueled. But the better part of that story is we wouldn't get into all the solvency issues that would then require all those drastic measures you're talking about. I love that idea. I think the odds of it being enacted are very low, at least proactively by today's politicians.
Well, statutorily, you could have. Let's look at the two options. One is to do this with statutes, and those have always failed. Every time we've had a statute, Graham-Rudman, for example, that worked for a couple of years. It was kind of like a Band-Aid, but the statutory changes on the fiscal front do not work. You've got to do a constitutional change, not a statutory. And the constitutional requires a constitutional convention under Article 5. And I'm on the board, actually, of a organization that is pushing this and moving it forward. And we might very well, I hope, have a constitutional convention on this topic. And that would change the structure on the fiscal front and cap things and save us from what will be essentially punishing taxes, either inflation taxes or real out of the pocket type taxes, one of the two. Yeah. You're going to get taxed one way or another, either with an inflation tax or paying Uncle Sam every April a larger chunk than you've been paying in the past.
Well, Godspeed to you on that, Steve. And I think I speak for the vast majority, if not all, the people watching this video. If there's any way that my viewers can help or support or participate in that, please let them know how to do so. On that note too, Steve, as we wrap things up here, for folks that have really enjoyed this conversation and would like to follow you in your work, where should they go?
They can follow me on Twitter, just at Steve_Hanke. And right now, I'm rated the third most influential economist in the world with this Twitter following.
Third most influential, but number one in our hearts, Steve.
Yeah, well, absolutely. And the other way, of course, just write me an email, hanke@jhu.edu, and I'll put you on my regular distribution list, or if you have some question, I'll try to answer it.
You're very courageous to share your email publicly. Thanks for that. And Steve, for better or worse, when I edit this, I will put up the links to your Twitter handle and your email there. Expect your email inbox to explode. Folks, I'll have links to those in the description below the video here. All right, Steve, in the last minute we have here, just in wrapping up, we've been talking about sort of financially related, money related issues this whole conversation. What's one non-money related investment of time, energy, focus, whatever, you would encourage people to consider adopting in their lives?
Well, speaking as a man, I think the critical thing is that choice you make when you decide to marry someone. Fortunately, I made the right one.
That is a great answer. I'm shocked that actually I've had a lot of people mention sort of relationships and whatnot, but choice of life partner has not come up yet. And I think that's a phenomenal answer. My wife is a marriage family therapist, so I kind of almost have to say that as her spouse. And having married a great spouse, I totally agree with you. And of course, there's everything from personal happiness and whatnot from making the right choice, but even just the dollars and cents of it, right? I think the data is really clear that one of the better things, like the better catalysts you can have in your life for financial well-being is actually having a good supportive spouse, correct?
Absolutely. There's no question about it. In my case, Mrs. Hanke and I collaborate across the board on everything, and including, by the way, what we're talking about, political economy, especially the geopolitical aspects of the thing. She comes in heavy duty. Uh, at, at one point in her life, she was a professor also at Johns Hopkins, teaching at Johns Hopkins, literary criticism. Since then, she's made a switch over into geopolitics.
Wow. Well, you are a wealthy man in many different ways, Steve. Great answer. Thank you so much for coming on the program. I really appreciate it. Look forward to having you back on later this year. Anytime you want to come on, especially if something on the dashboard that you monitor really starts flashing in a way you want to get out in the world. But can't thank you enough. It's been such a pleasure to have you back on.
Well, thanks for having me, Adam. Good to be with you again. Thank you.
All right, well, now's the time of the program where we bring in the lead partners from New Harbor Financial, one of the financial advisors endorsed by Thoughtful Money, to come on. We'll react quickly to the great discussion we just had there with Steve, but they'll also tell us sort of what's been on their radar over the past week as we've just finished up this barn burner of a Q1. I'm joined as usual by lead partners John Lodra and Mike Preston. Guys, thanks so much for joining. Mike, what do you have to think about the conversation there with Steve?
Hey, Adam. It was a great talk with Steve. Steve talked he basically started off the talk. You asked him what he thought about the global financial markets. He said, well, we're sailing pretty smoothly right now, but we've got two wars going on and a lot of uncertainty. And we have the market at a very pricey level. He said we were at a price to earnings ratio of 30. I'm not sure exactly which price earnings ratio he was using, but that's in the ballpark, depending upon which way you look at it. The Schiller price earnings ratio is even higher, up in the mid to high 30s. And so if you look at the price earnings ratio on a 10-year smooth basis, like the Schiller PE ratio, it's a lot more reliable. And it shows that we're at nosebleed levels. We've never been here except for at the very top in 1999 and 2000 and 1929. So he said right about at that point in the talk that he likes to sit in cash and wait for the crash. And I kind of like how that rhymed. And that's not what we're doing exactly here at New Harbor, but we're doing some of that in that we have a little over 40% cash equivalent still. We've made a lot of changes in our portfolio the last couple months, which we'll talk about probably later in this talk. But when Steve said sit in cash and wait for the crash, like Warren Buffett does, and Warren Buffett, by the way, has something like it's either 180 billion or 280 billion in cash. I can't remember which it was, but it's a record high for Berkshire Hathaway too. So professional investors are seeing this. He talked about the money supply, and he said, I think he said, Milton Friedman said, inflation is a money supply situation. And if you can enable sharing, Adam, I'm just going to share the chart of the money supply. And he said the money supply peaked in 2022 and it's been trending down. That indeed is true, but it hasn't really been much of a move. I'm just going to show it here quickly if I can. And this is the St. Louis Fed website. For the people that don't know, you can go here to fred.stlouisfed.org. There's a whole bunch of different charts here put out by the Federal Reserve themselves. But M2 money supply went from around 15, 16 trillion. And that was right as COVID started. And we went from 15 to 20. Or even higher, maybe 14 to 21. So the money supply exploded by 50% in 1 year during COVID. And that's another way of saying that one out of every $3 in existence during that time was created in that year, which is pretty crazy.
And sorry to interrupt, but because of the quantity formula of money, that's why Steve was so confident in making that 9% inflation prediction call way back when, because he saw that surge in the money supply and just put that into the equation and said, oh, because of money supply increased by this much, inflation is going to have to increase by that much.
It was insane. And so obviously we had inflation. Inflation went right to 9% and I bonds were paying 9%. And it felt like that was going to last forever. Well, we've actually trended down pretty smoothly into the maybe 4% range or so. But Steve said we peaked in 22 in the money supply. He's right. We did right here. But you really have to kind of squint to see the reduction. So I'm not sure that I see or that I'm as confident as he is, but he's obviously the expert in this field and I'm not. But it's not really a big drop after what we've seen here. So we'll see if that actually does feed through and creates a recession. He thinks that we're going to see a recession next year. I heard him say at the end of the talk, unless the Fed does something big, but he thinks they're going to be late. And we agree. They're probably going to be late to the party. They're going to wait for some kind of crash or big drop in the market, and then they're going to do something. Even though the dot plot shows some minor changes this year, maybe as many as 3 interest rate cuts, I think they're going to be very, very slow. And, the market's anticipating them already. There's certainly not going to be large resounding rate cuts that one would expect to see in response to a panic. So he reiterated that changes in money supply are the key to everything. We'll see. And he said the 10-year yield he thinks is going to be under pressure, particularly if we have this recession. And the Fed has to respond, even if it's late to the game, even if they've got to respond that the 10-year yield should go down. And he thinks that buying 10-year bonds here makes a lot of sense. We agree. It may take a while to respond because investments like TLT is still hanging around in the mid 90s and the 10-year yield is still at around 4.2. But the 10-year yield should go down towards 3% again when the Fed reacts and when we have some kind of big downturn in the market. So we agree that being invested in long-term bonds, he said the 10-year, but even longer bonds can make a lot of sense. So I think I'll stop there and take a pause and give John a chance to say something. And
John, we'll come to you in just one sec. One thing I just want to note is of the topics, there's a whole slew of experts that come on this channel every week, right? And they all have different viewpoints, all have different outlooks. I would say the majority of them are concerned about overstretched market valuations, are concerned about things like the lag effects and eventually the economy slowing down and recession being in the mix somewhere in the future. But I would say that one of the things that I see the greatest disagreement on amongst the folks that I talk to is inflation. I've definitely got fair amount of people and they're like, hey, it's going to be just inflation is going to be secularly higher going forward. Interest rates are going to be higher going forward than we've been used to. I had some on last week delivering that message. And then we have folks like Steve Hanke or Lacey Hunt or Stephanie Pomboy or whatnot who are saying, look, no, we think that, disinflation and really, eventually deflation is the bigger thing to worry about. Lacey, if you watched his keynote presentation from the recent spring conference we just did 2 weeks ago, he walked through a zillion charts explaining this in great depth, going into the shrinking money supply and all that stuff. So it's going to be really interesting. That's one where it seems like there's going to be real winners on the side of that bet and real losers on the side of that bet. And according to Steve, we're not going to have too much longer to wait to find out. By the end of this year, it really should be pretty clear who's won that bet. So anyways, it's going to be interesting. John, let me hand it over to you. Anything you want to add to what Mike just said there?
Yeah, sure. I too really enjoyed Steve's comments. He's a very astute analyst and I like his style. I actually had a chart handy. I was given the privilege to be a guest speaker at a Bentley University class last week, I think it was. Mostly seniors, college seniors. So it was a really exciting thing for me. I got to do a little bit of a Adam Taggart educational give back to the world kind of thing. So it was really on a much smaller scale. There's probably 30 people in the class.
It's okay. I'm sure you sounded a lot smarter.
I don't know about that, but it was great because I was able to bring some of these charts that we oftentimes obsess over into the classroom of the next generation. And I actually had one on Steve talked about the money side supply as a percent of GDP as kind of a key thing. Mike just brought up the M2 chart, which is shocking in its own right. It in some ways is more shocking if you look at it on the metric that Steve talked about. So I'll just share that. Again, I had this chart from that talk I gave. And as sharp as the rise that Mike showed on a percentage of GDP basis, it was actually quite a bit more shocking. I mean, that is like as vertical as you can get. Now the pullback, you know, Steve's talk about the drain of money supply as money M2 over GDP. It has been a little bit more pronounced on that basis if you look at as compared to if you look at just GDP. But you know, I wanted to kind of I have that chart handy, so I want to. But that is pretty dramatic. You look at this chart goes back to the 60s. It you know range bound there. You know, 50 to you know, maybe 55, 60%. There's late 90s. It got pretty low, but look at that. Look at over the last in response to the great financial crisis and then COVID. I mean, it's just off the charts, absurd compared to what history would have talked about. Just a couple other charts. Maybe I'll just throw in that I had handy. You know, he talked about if he was king, he would institute a rule like I think he said Switzerland put in place that debt can't grow faster than GDP. Well, this is what our debt to GDP chart looks like here in the U.S. You know, we've crossed that over and it's been accelerating. Now, if you look on a percentage basis, yeah, the rate has maybe declined recently, but look at that little uptick there. So I would vote for him as king if that was the one pillar of things to consider.
Me too. And John, go back and pull up the debt to GDP chart there. Just the absolute value of both. So the chart before this one. Yeah. So this is the absolute value of both of those numbers, right? So the debt is now bigger than GDP, right?
Oh yeah.
But if this were a map of the growth rates of debt versus GDP, debt's been growing faster than GDP since pretty much the mid 70s.
And that's basically this chart. Anytime the slope here is increasing, that's basically saying the debt is growing faster.
Yeah, you know, you're absolutely right. You're absolutely right.
Yeah, that's a pretty upward sloping line with a couple of brief pauses.
Yeah, but I mean, it just means and it looks like it's really the early 80s is when it really started taking off. But for most people who are watching this video, it's been the entirety of their adult life, right? So what we think of as normal, right, is this period of debts growing faster than our national debt growing faster than our income, right? Which is essentially, if you're a household, that's like growing your debts faster than your household income, right? Which is it feels great. You feel wealthier because you've got money to spend, but there's a piper to be paid at some point in the future, right?
You know, debt, you point out, yeah, the debt did start taking off in the 80s. That's also when a 40-year decline in interest rates started. So the ability to take on more debt had this huge tailwind. Are we going to have another 40-year tailwind of declining interest rates from where we are now? I don't think so. At least certainly not to the same degree. So we're in a brand new environment. And you know, one of the other things I had to inform the Bentley students about is you know, I told them to look at their pay stubs. I put up a screen of a mock pay stub, and it said, you know, what are these FICA things? And I showed that, and I said, this is you paying your share of government programs. And oh, by the way, this next slide is right off of the Social Security website that 2034, the fund is going to be unable to pay full promises, right? So yeah, we got some things we're running towards here that are the can is can't be kicked down the road decades like it was before.
So I'm curious, John, how you do this, because I have to speak to lots of audiences on this stuff, and you want to make the audience aware of the reality of the situation. And talking to younger audiences, it's even more important for them to become aware. Because they're the ones that are going to have to live the longest in this future that's coming, and you can make the biggest differences in their lives if they make good changes now. But how do you have that conversation without just crushing their optimism for their future?
Yeah, it's a grip because I was very concerned about that, and I kind of put it in the context of you know, this isn't going to fix itself. Your generation has a lot of power here, especially when you think about voting, and I told them that politicians aren't leaders, they're followers. You just got to make them follow you, and the only way you do that is by demanding more. You can't be passive in the arena when it comes to politics. You gotta vote as a simple thing, even if you think it doesn't matter. If you take that attitude, you're gonna have a lifestyle of thinking things don't matter. You got to do those little things, even like voting, if you're gonna do the big things right. So yeah, it was a tricky message, but look, we all deserve truth, and especially our young folks.
Yeah, you have to have it. You don't do anybody any favors by sugarcoating it. I always just find it is a challenging art to be able to be honest, to hold their attention, and to not just completely demoralize them. I'm not saying I'm perfect at it, so I was just curious how you fielded it. All right. Well, look, in the remaining few minutes we have here, guys. So we just finished a Q1 where pretty much everything went up. The dollar went up, gold went up. Maybe bond prices didn't go up so much, but bond yields went up a bit. The S&P went up by a lot. The NASDAQ went up by a lot. The Russell 2000 went up by a lot. Bitcoin went up by a lot. Kind of everything we can think of, practically has gone up, right? So from the casual observer's perspective, what's there to worry about? This is like best environment ever. Strong GDP growth, low unemployment, easy to make money in the markets. Want to give you guys a chance to react in any way to that as capital managers right now, because my sense is you're not taking the current market environment as a signal to go whole hog and go long everything. Mike, let's go to you.
No, absolutely not. I mean, you're right. Everything is up. Everything's at all-time highs. It's pretty surreal, actually. The market's been up, I don't know, 15, 16 or 17 weeks out of the last 18, or it's been down maybe 1 or 2 weeks. It's been a relentless up move, but it has been persistent and relentless. And we can't deny the indicators that continually point upwards. And the problem is it's like a pressure cooker. It just continues to build pressure and pressure and pressure. And that pressure is up for now, but it becomes ever more unpredictable as the trend continues. And that's what's tough for individual investors. And that's what's tough for us. We're using our tools the best we can to participate and have good risk controls on board. We're somewhere around the low 40s, 40-something%, depending upon the account. Exposed to equities, we've got some really good tight hedges on board. We have had the ability to adjust those hedges. Just yesterday or the day before, we adjusted one of our hedges on the S&P. We had moved previously from 4,500 to 4,700 on the S&P. We just moved it up further to the 4,900 level. So as the market goes up, we keep moving that floor up little by little because it costs us less and less to do so as that market goes up. But the S&P finished the first quarter up 10%, huge up quarter. And I just read somewhere something like 94% of the time when the first quarter is up, then the S&P is up for the year. I don't think you can rely on those things, particularly not in an election year, but it was a really strong quarter, and it's been straight up since October of last year. But you know what else is at an all-time high? Gold. Gold is up 8%, roughly, for the year to date, and it's got a massive breakout on a long-term chart that we've been talking about so often here. Bitcoin is at an all-time high. Everything's at an all-time high. Real estate, everything across the board. So pretty frustrating as a money manager, but we have and as an individual investor, but we have a system. And we do have exposure in the 40s, like I said.
Yeah, sorry to interrupt you there, but just to, I want to help you explain the cognitive dissonance that might be in some viewers' minds, where you're saying everything's at an all-time high. That's frustrating as a money manager. I think a lot of people be like, "What do you mean? You should be like partying."
The reason is we don't have a static allocation. If we just put people in the market and let it sit there over time, it would feel great right now. And maybe we'd be a little nervous as it keeps going up, but it's not. We know it's not real. We know that a good part of what we're seeing here is not going to stay. It's an illusion, so to speak. And this market can and will turn and probably wipe away many years of gains. It's happened twice already in my career. It's happened twice already in the last 25 years. The tech crash, the housing crash, this one should be bigger if it ever happens, if it's ever allowed to happen. So that's why it's frustrating. Those that know the truth, that can see the data, that are trying to educate people, are frustrated because we're trying to get a little bit of gain, and we are, but we don't want to give up that much if we crash from here. we have to accept something, a few percent to the downside. But for the most part, we're trying to get some very conservative gains and give up very little on the term.
All right. And again, we've talked a lot in the past about your risk management tools, so we won't go into them in detail now, but you talked a bit about how you keep raising the hedges that you have on your portfolios as the market goes up, which is what gives you the ability to sleep at night while you're long in this market, where if there's a big downdraft that comes out of the blue, like you fear could happen at some point, you've got the insurance in place. You've got that safety net in place to minimize your downside risk. John, I'm coming to you here. I just want to give you one thing to react to, which is, I talked to a lot of people. I've been doing this now for 3 years, and nobody has a crystal ball, right? So a lot of people have outlooks that have not panned out exactly the way they thought they would, and that's more the norm, right? Because the future is unknowable. But I do like to shine a light where somebody really nailed a prediction, and I talk about like how Darius Dale coming into Q4 coming into Q1 said his model was the most bullish he'd ever seen it, that thought Q1 was going to be great. Well, Q1 turned out to be great, so I'd like to give Darius props for that. Steve really nailed that inflation, 9% inflation prediction at a time where it was, like I said, really hard to believe. And he did it with math, right? He's an economist, and he pulled up the quantity theory money, and he walked us all through the why and the how of each of the inputs and said, hey, since money supplies increase by this much, inflation's going to have to increase by this much going forward. And the formula was right. So I think you have to take with a lot of respect the prediction of that same formula going forward now that money supply is shrinking, right? And if so, then Steve says, look, unless the Fed goes bananas quickly on the rescue side of things, we're highly likely going to have some sort of contraction in the economy, probably as soon as the end of this year, early next year. So, how do you guys take that into account in your management strategy for your clients' wealth going forward?
Well, one thing we can say with 100% confidence is that in the short term, the market can and oftentimes will do things that are completely at odds with what the fundamentals should say. We'll be candid. We're more invested in stocks right now than from a fundamental standpoint we would otherwise want to be. And why is that? Because many of the technical indicators that we follow, which technical indicators are more or less a kind of code word for psychology and investor psychology behavior, whether it makes sense or not. Sometimes it's downright insane. So some of the data that, folks like Steve pointed to, really for us set the backdrop for what kind of risk controls make sense to have, even if in the short term we may be positioning in ways that we think are at odds with the bigger picture fundamentals. So for example, just late last week, we added a slice of a position long equities in the Russell 2000. It's an index that has lagged, but there was a pretty convincing breakout there and a gain in relative strength and things like that. But we did so with very tight hedges. We did a collar position that over 50 days, it has a 50-day life, has upside potential of about 4%, with a downside risk of no more than 3%. Right, so very contained risk. We think in the short term, given some of the technicals, we're likely to see more upside than downside. But if we get it completely wrong there, first of all, our position size is very small, but we've got these put options that we fully paid for and then some by taking in premium by selling the call. So we feel very comfortable straddling that line. But make no mistake about it, we wouldn't have been comfortable adding a bigger position or one without the belt and suspenders that we've had. So yeah, I mean, kudos. I mean, it's Steve certainly was a lonely. He was making that call at a time when everybody that had a pulpit was saying this is transitory, the Fed included. And yeah, it came back to you can't just do these things without at some point having a consequence. They're not perfect indicators. He himself pointed out that the lag effects are oftentimes long and variable, but they're still there. And you have to be cognizant of that and understand that you can't be perfect, but the consequences of of being imperfect and on the wrong side of things are far greater than being imperfect and on the right side of things in the big picture.
All right. Well said. All right. Well, look, we'll have to start wrapping it up here, guys. Folks watching, a couple of quick things. One, if you enjoyed the conversation here with Steve, would like for Steve to come back on the program, please let him know that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And as I think Steve, but certainly John and Mike have really been emphasizing here, it's a tricky time, especially for the average investor who's just trying to make sense of what's going to happen next in these markets. And you've got the current FOMO raging mania that's going on, but also the very sobering warnings that Steve for sure is ringing. Of course, a lot of other folks on this channel are ringing similar versions of it. And most people, you've got real lives, families, jobs, stuff to focus on, and you just whatever happens, you just don't want to become collateral damage to it. So I highly recommend that the vast majority of people who are watching this shouldn't go it along and just try to sort of figure it out, groping in the dark. You should be working under the guidance of a good professional financial advisor who takes into account all the issues that Steve and I talked about, that John and Mike have mentioned here, and then puts together a personalized strategy for you and then executes it for you. If you've got a good one who's doing that, great, you should stick with them. But if you don't, or you'd like a second opinion from one who does, maybe even John and Mike and their team here from New Harbor Financial, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there, only takes a couple of seconds. You then get a fully personalized, bespoke consultation with the advisor that you get matched with or that you indicate you want to talk to. These consultations are totally free. There's no commitment to work with these guys. It's just a free public service they offer to help as many people as possible position as prudently as possible today for what might be coming down the road. John and Mike, thanks so much again, guys, for hanging with me for yet another week. Maybe next week we can do, if gold continues its breakout here, as you've been predicting for a long time, guys, especially you, Mike. Maybe we can do a deeper dive into that and the miners specifically, because it looks like that complex, which has been much hated for very long, may be showing some signs of life right now. But we'll save that for next week. Guys, look forward to whatever happens between now and then. You guys making good sense for everybody here and everybody else who's been watching. Thanks so much for watching.
And thank you, Adam. I'll see you next week.
Thank you again, Adam. See you soon.